Okay, hello everyone, and welcome to our last class of this webinar conducted by ACCA for our students. And in today's class, as you all know, we would be discussing mergers and acquisitions. So obviously, mergers and acquisitions involves valuations, and we need to discuss the fact to consider the fact that when we are one particular company and we are trying to acquire another company, they become two companies, the combined companies, okay, 1+1, okay. So when we acquire the other company, there are different ways of acquiring. Firstly, we don't acquire their assets, we don't acquire their liabilities, we acquire their shares, equity, because when we get equity, everything is ours, okay. And we discussed yesterday that you can pay cash against shares, bonds against shares, or a share for share exchange, okay. But before acquiring that company, you would be very much interested in finding the value or the valuation of that company, okay. So valuation involves different methods. Some methods say valuation depends on assets, some methods states that valuation depends on dividends, but some methods say valuation depends on future free cash flows, okay. That's free cash flow method of valuation, which we are going to cover. So I told you that free cash flow valuation method states business is worth the discounted value of future cash flows, not the current cash flows, but the future cash flows, okay. So one approach is FCF to company, one is called FCF to equity, okay. You take revenue, deduct cash costs and TAD, okay. I want to tell you one thing here, that it's written revenue, deduct cash cost and TAD, okay. Just to make things more comfortable for you, when you deduct cash costs and tax allowable depreciation from revenue, you get operating profit. It's not written in the format, it's just for your general understanding that when you take revenue, deduct cash costs and TAD, you get operating profit, okay. From operating profit, you deduct interest. From operating profit, you deduct interest, okay. So after that, you get taxable profit. On the taxable profit, you pay tax, then you add back TAD, less investment in working capital, investment in NCA, you get FCA. Okay, so there is one thing not present in the format. However, obviously the answer would be the same. When you take revenue and deduct cash costs and TAD, the format moves towards interest, but I just want to make things a little bit easier for you. That take revenue, deduct cash costs and TAD, so you reach operating profit. After operating profit, that's interest and taxable profit we reach, then tax paid, add back TAD, investment in NCA, investment in working capital, we get FCA. If you're doing FCF to company, deduct interest. If you're doing FCF to equity, don't deduct interest, okay. Multiply this FCF by the discount rate. If FCF to company, the discount rate is WACC, else it's K, you get value of entity, and deduct value of debt from that to get value of equity, okay. We'll be doing a question. Okay. Let me first share this file in which there is format with all of you. People are asking. So I have shared that question on the WhatsApp group. Okay. So it's not needed during class. After the class, you can watch it. And in the meantime, we will be moving towards our question, pursuit company. You know that the basic information is present in the front screen, but in the exhibits, we have detailed information. So I'm opening the exhibit. You all have the questions with you as well. Okay, you can, it's your wish. You want to watch it from my screen or you want to watch it on your own. It's completely your choice. Okay, so the question states, pursuit company, a listed company which manufactures electronic components, is interested in acquiring further company, an unlisted company involved in the development of sophisticated but high risk electronic products. Okay, the owners of further are a consortium of private equity investors who have been looking for a suitable buyer for their company for some time. Pursuit estimates that the payment of equity value plus 25% premium would be sufficient to secure the purchase of further. Pursuit would also pay off any outstanding debt that further owed. Pursuit wishes to acquire further using a combination of debt finance and cash reserves of 20 million, such that capital structure of the combined company remains at Pursuit's current capital structure level. Okay. Now, I just know that in a comprehensive scenario, all information is not relevant. The best thing is that please pay attention, try to gather the important information. Now, in the first line, Pursuit, a listed company which manufactures electronic components, is interested in acquiring further company. There is a company called Pursuit company. Okay. It's the buyer. And it's interested in acquiring further company, which is the seller. The owners of further are a consortium of private investors who have been looking for a suitable buyer for their company for some time. Pursuit estimates that a payment of equity value plus 25% premium would be sufficient to secure purchase of further. Pursuit would also pay off any outstanding debt that further owed. Pursuit wishes to acquire further using a combination of debt and cash reserve, such that capital structure of the combined company remains at Pursuit's current capital structure level. Another important thing. Capital structure, that is debt to equity composition. Capital structure means debt to equity composition of combined company remains at Pursuit's current capital structure level. This is very interesting. Let's suppose Pursuit's capital structure, the debt to equity composition is 50-50. So it states the capital structure of combined company will remain at Pursuit's current level. The combined company will also have that 50-50. Okay, that ends the exhibit 1. Exhibit 2. In exhibit 2, you're given information about Pursuit company. In exhibit 2, you're given information about Pursuit company. Okay. Pursuit company has a market debt to equity ratio of 50-50. Now the debt to equity ratio, that's what capital structure means. Debt to equity composition is 50-50%. Equity beta is 1.18. Currently Pursuit has a total firm value, market value of debt and equity combined of 140. Okay, this is Pursuit's information, that Pursuit has a market debt to equity ratio 50-50. The composition is 50-50. Equity beta is 1.18. Currently Pursuit has total firm value, the equity debt value combined of 140 million. That's it. That ends Pursuit's information, that Pursuit's debt to equity composition is 50-50. It has an equity beta of 1.1. Okay. Now equity beta is used in WACC. The only reason of selecting this question was that WACC can also be covered. Otherwise, there are no more questions of mergers and acquisitions with WACC in it. The only reason of selecting this particular question was that we can cover WACC as well. Okay, so Pursuit's capital structure debt to equity is 50-50, equity beta 1.18, and its market value is 140 million. Now you're given information about Fodder company. Let's check the Fodder company information. Now, as it seems, 4-year data of Fodder company is given. 31st May 2011 year end, then 2010, then 9, then 8. 4-year data is given. Revenue from right to left from 2008 to 2011 has been steadily increasing. 13559, 14491, 15229, 16146. Okay. Now, after revenue, you're given with operating profit. After revenue, you are given with operating profit. 4530, 4243, 5074, 5169. Now note this thing. What's written with operating profit? Operating profit, and after that in bracket is mentioned after operating costs and TAD. I told you this thing before. See, look at this format that I just told you. Operating profit comes after deducting cash costs and TAD. I told you one thing. See, this operating profit comes after deducting cash costs and TAD. That's exactly what question is saying. That question says that revenue, and after that no cash cost and TAD is given, directly operating profit is given. So that's why operating profit is after cash cost and TAD. That's what it's mentioned. Then interest is deducted, you get PBT, profit before tax is a taxable profit. After that you pay tax at 28%, you get after tax profit, then you pay dividends, and the balance is retained. So in short, 4-year data for our company is given. The next information says Fodder has a market debt to equity ratio of 1090. Fodder's debt to equity ratio, the capital structure is 1090. 10% debt, 90% equity. What was Pursuit's the buyer one? 50-50, 50% debt, 50% equity. But Fodder has a debt to equity ratio of 10%, 90%, an estimated equity beta of 1.53. Okay, it can be assumed that its TAD is equivalent to the amount of investment needed to maintain current operational levels. The question states it can be assumed its tax allowable depreciation is equal to investment needed to maintain operations. Now remember this thing, investment needed to maintain operations is basically working capital. Investment needed to maintain operations is working capital. So the question is asking you to assume that its tax allowable depreciation is equal to amount of investment needed to maintain operations. That means its tax allowable depreciation is equivalent to working capital. I told you that we will write the main stuffs. So the main stuff is, going back to the question, Fodder has debt to equity ratio of 1090%, equity beta 1.53. It can be assumed that tax allowable depreciation is equivalent to amount of investment needed to maintain operation levels. So amount of investment needed to maintain operations is working capital. Its TAD is working capital. However, Fodder will require an additional investment in assets of 22 cents per $1 increase in revenue for the next 4 years. It is anticipated that Fodder will pay interest at 9% on its future borrowings. Okay, so it's information about Fodder. Firstly, the 4-year historical revenue and operating profit and interest and PBT and tax and PAT and dividend was given. Fodder's debt to equity ratio is 1090%, equity beta 1.53. Assume its TAD is equal to amount of investment needed to maintain operations, that is working capital. However, Fodder needs additional 0.22 per dollar when increase in revenue for the next 4 years. Fodder will pay 9% interest on its borrowings. Last para of this exhibit 2. For the next 4 years, Fodder's revenue will grow at the same rate as previous years. For the next 4 years, Fodder's revenue will grow at the same rate as previous years. Very important thing. That for the next 4 years, Fodder's revenue will grow at same rate as previous years. See the stuff I've highlighted. For the next 4 years, Fodder's revenue will grow at same rate as previous years. I don't know what is the number, but it is mentioned that for the next 4 years, Fodder's revenue will grow at same rate as previous years. So can you check the revenue growth rate of previous years through this revenue data? Yes. The question states that for the next 4 years, Fodder's revenue will grow at same rate as previous years. So you can check the growth rate of previous years. We have 4-year data. And for the next 4 years, the revenue is going to grow by exactly the same rate as previous years. So just randomly check the revenue growth rate of previous years. From 2008 to 9, revenue became 13559 to 14491. You can check this from 13559 to 14491. You can just take the difference and convert it into percentage. The growth rate is 6%. Okay. Now, next 14491 to 15229. Again, you can take the difference and take the percentage. Again, it's 6% from 2009 to 2010. And from 2010 to 11, again, you can see the revenue is 15229 and became 16146. You can take the difference. It's again 6%. So for the next 4 years, Fodder's revenue will grow at same rate as previous years. So you can just see the previous year's growth rate. Every year carries growth rate of 6%. So I should write this as well. For next 4 years, revenue will grow at same rate as previous years. So what is the previous year's growth rate? 6%. So for the next 4 years, revenue will grow by 6%. Okay. See the last time. After 4-year period, what happened after 4-year period? The growth rate of its free cash flows will be half the revenue growth rate for the foreseeable future. After 4 years, growth rate of free cash flows will be half the revenue growth rate for the foreseeable future. So what means by the half revenue growth rate? The growth rate of future cash flows will be half of revenue growth. It will be 3% for foreseeable future. Okay, I'm just repeating and I will give you a minute to copy this stuff. Go back to the question again. Last 2 paragraphs. Now in exhibit 1 and 2, see carefully. In exhibit 1, I have opened exhibit 1. Pursuit, a listed company which manufactures electronic components, is interested in acquiring Fodder. So Pursuit was the buyer, Fodder was the seller. Okay. And another important thing, Pursuit wishes to acquire Fodder using a combination of debt and cash reserves, so that capital structure of combined company, the debt to equity composition of combined company remains at Pursuit's level. Okay. Exhibit 2. Exhibit 2 started with Pursuit company, the buyer. It has a debt to equity composition, capital structure of 50%, equity beta of 1.18, and it is the firm value of 140 million. Then you were given with the seller's information Fodder, income statement. Revenue is given for 4 years, previous 4 years, 8, 9, 10, 11. The operating profit was given, which is obviously after TAD and cash costs. You get interest, profit, taxable profit, tax, after tax profit, dividends, earnings. Last 2 paragraphs were very important. Fodder has a debt to equity composition, debt to equity ratio 10-90%, equity beta 1.53, It can be assumed TAD is equal to amount of investment needed to maintain operational levels. I told you amount of investment needed to maintain operational levels is working capital. So TAD is equal to working capital. Okay. However, Fodder will require additional investment in assets of 0.22, 22 cents per dollar when increasing revenue for the next 4 years. It is anticipated Fodder will pay interest at 9%. Okay. Loss. For the next 4 years, Fodder's revenue will grow at the same rate as previous years. I just checked the revenue growth rate of previous years. It was 6%. So I wrote that for the next 4 years, Fodder's revenue will grow at 6%. After 4-year period, the growth rate of revenue, no, the growth rate of free cash flows will be half the initial revenue growth rate, 3% for the foreseeable future. Okay, you can note this important stuff. If you have any questions, please ask in these 2 exhibits. Sri Kautalya, we don't know what we have to do here, whether we compute NPV or whatever. It depends on the requirement. So let me first read the requirement, then I will be able to guide you better. Aman, you have to wait for this. You should see what I do here. Okay, so one person is saying that how do we compute the revenue growth rate? Okay, pay attention to me. The revenue growth rate is basically growth rate of anything is the difference divided by the old one. Like if anyone says you take the difference of 8 and 10, what is the growth? You take the difference and divide by the old one, 8. So you take the revenue difference and divide by the previous one. You get 6%. Now, there are many people who obviously computed the revenue growth rate. There are some people who only copy the stuff and some people compute. So they are saying that the growth rate in the first one is coming 6.8%. The second is coming 5%. The third is coming 6.02%. So see the question stated that for the next 4 years, revenue will grow at the same average rate as previous years. So since the 3-year rates are different, you can just average them. Okay. If you add them all, divided by 3, you will get approx 6%. So then you can use that formula as well, no problem in that. Mohammed Safwan, I will provide you a list of important questions which I consider that are valid for this attempt, but it will always be with a disclaimer. Important questions doesn't mean that you only do those questions and leave all the stuff. Obviously, you have to complete your studies with everything, and then you can do the important questions. Yes, Amsal, you can use that formula as well. Few students are asking emails for questions because they don't use WhatsApp. So I am sending email address to everyone as well. Okay, so we have done 2 exhibits. Let's go back to the question. I just sent one file. I don't know why you aren't able to see. You can message me after the class. I've shared the email address with all of you. Minal, your question doesn't seem relevant, because your question is, could we use dividend growth model for calculation of FCF? It's practically not possible. Dividend growth model is another model, and free cash flow model is another model. Dividend growth model states that the value depends on dividends. Free cash flow method states that value depends on free cash flows. How can you mix 2 methods? It's not possible. Uda, I will answer your question, because we have been provided this platform in which from the scratch we have to upload it. So you should contact your learning provider. The learning provider uploads and provides to student. Salima, you just wait and see. If we are finding value of a particular company, we will use that company's discount rate. But when we are doing for combined company, we'll use a combined company rate. Okay. Faizan, they are shared multiple times in the WhatsApp group. They are shared by ACCA as well on this platform. So you can use any of the source for that. Okay. So we have done 2 exhibits and noted the information. Now move towards exhibit 3. Okay. Now exhibit 3 states, following the acquisition, it is expected that combined company's sales revenue will be 51,952,000 in the first year, and its profit margin on sales will be 30% for the foreseeable future. Now, following the acquisition, it is expected that combined company's revenue will be 51,952 in the first year. Now, pay attention. In the previous exhibit, you were given information about Pursuit separately, further separately, following the acquisition. In the previous exhibits, you were given information about Pursuit separately. You were given information about fodder separately. Now it states, following the acquisition, it is expected that combined company's revenue will be 51,952. Now this exhibit 3 is giving information about combined company. Previously, I wasn't given information about combined company. I was giving information about Pursuit separately, fodder separately. Combined revenue will be 51,952 in first year. Profit margin, operating profit, that's 30%. After the first year, the growth in revenue will be 5.8% per year for the following 3 years. So after the first year, the growth rate in revenue will be 5.8%. Okay, so after the first year, the growth rate in revenue will be 5.8% per year for the following 3 years. Following the acquisition, it is expected that combined company will pay interest at 6.4%. So combined company will pay interest at 6.4%. The combined company will require additional investment in assets of 513,000 in the first year, and then 18 cents per $1 increase in revenue for the next 3 years. It is anticipated that after the forecast 4-year period, its free cash flow growth rate will be half the revenue growth rate. It is anticipated that after the forecasted 4-year period, the free cash flow growth rate will be half the revenue growth rate. Now look at the paragraph number 1. The revenue growth rate is 5.8%. The revenue growth rate is 5.8%. So the question states that it is anticipated that after 4-year period, the free cash flow growth rate will be half the revenue growth rate. That is 2.9%. After the 4-year period, the free cash flow growth rate will be half the revenue growth rate, that is 2.9%. It can be assumed that the asset beta of the combined company is the weighted average of individual companies' asset betas. So asset beta of the combined company is the weighted average of individual companies' asset betas, weighted in proportion to individual companies' market value. We will discuss this point in WACC, that you need to assume that the asset beta of the combined company is weighted average of individual companies' asset betas. Okay. Other information. The current annual government base rate is 4.5% and risk premium is 6%. The relevant tax rate is 28%. So current annual government base rate is 4.5%, risk premium 6%, and tax rate is 28%. Last exhibit. There have been rumors of a potential bid by SGF company to acquire Pursuit company. Some financial press reports have suggested this is because Pursuit share price has fallen recently. SGF is in a similar line of business as Pursuit, and until a couple of years ago, SGF was the smaller company. However, a successful performance has resulted in share price rising, and SGF is now the larger company. So in all the exhibits, Pursuit was acquiring fodder. In all the exhibits, Pursuit was acquiring fodder. But here in the last exhibit, it states that there are some rumors that some SGF company is willing to acquire Pursuit. Last part. The rumors of SGF's interest have raised doubts about Pursuit's ability to acquire fodder. So the rumors of SGF's interest in Pursuit have raised concerns that whether Pursuit will be able to acquire fodder. Also, SGF has made no formal bid yet. Pursuit's board is keen to reduce the possibility of such a bid. The CFO suggested that the most effective way to reduce the possibility of takeover would be distribute the $20 million in cash reserves to shareholders in the form of a special dividend. Fodder would then be purchased using debt finance. He conceded this would increase Pursuit's gearing, but suggested it may increase the company's share price and make Pursuit less appealing to SGF. So in short, the CFO wants to distribute the 20 million reserves in dividend so that share price goes up and SGF is unable to acquire this. Okay, so all 4 exhibits are complete now. We will move towards the requirement. I can take any questions before requirements if you want to ask any questions regarding this question, because if question is clear, then only you can be clear with the solutions. Minal, sorry, it's time left in break. We can't give break or just after 35 minutes of starting the session. Okay, so no questions up till now. Okay, the summary of the question is very clear. Pursuit wishes to acquire fodder. Okay, information about Pursuit was given. Information about fodder was given. Information about Pursuit was given, and information about fodder was given. Okay, so the capital structure was given, the debt equity composition, and similarly the P&L format was given. There were some technical terms like for the next 4 years, fodder's revenue will grow at same rate as previous years, that was 6%. After 4-year period, it will be half 3% for the foreseeable future. Not the revenue growth rate, but the free cash flow rate. And then you were given with the combined company information that combined company's revenue was this in the first year, etc. Okay. Let's move towards the requirements now. The requirement states, prepare a report to the board of directors of Pursuit. You need to prepare a report to the board of directors of Pursuit that evaluates whether acquisition of fodder would be beneficial to Pursuit and its shareholders. Now, remember a student was asking yesterday a question that the main problem with mergers is that we don't know what to do. So it states, the requirement 1, evaluate whether acquisition of further would be beneficial to pursuit and shareholders. This is the requirement, that you need to evaluate whether acquisition of further is beneficial to pursuit and shareholders, whether acquisition of further is beneficial to pursuit and shareholders. Now, frankly speaking, as far as the student is concerned, he doesn't know what to do here. He needs to evaluate whether acquisition of further is beneficial to pursuit and shareholders, whether acquisition of further is beneficial to pursuit and shareholders. So frankly speaking, a student won't get any idea what to do after looking at this requirement, that I need to evaluate whether acquisition of further is beneficial to pursuit and shareholders. Read the requirement. See, the free cash flow to firm method. What is the meaning of free cash flow to firm? Firm is equity or company? Firm is company. Firm means company. The free cash flow to firm, that means the free cash flow to company method, shall be used to estimate values of further and the combined company. This is, you got a crystal clear idea that the requirement is saying free cash flow to firm, that is company method, shall be used to find value of further and combined company. The free cash flow to firm, that is free cash flow to company method, shall be used to find value of further and combined company. So free cash flow to firm, free cash flow company method should be used to estimate value of further and combined company. So easy. The question has provided you information what to do, that it states the free. I'm not getting anything being a student from listening to the first line. Evaluate whether acquisition of further would be beneficial to pursuit and shareholders. Difficult thing to do, but the question is guiding. The free cash flow to firm method should be used to estimate value of further. You need to estimate the value of further, free cash flow to firm method, and the combined company. You also need to estimate the value of combined company, assuming combined's capital structure stays the same at pursuit's capital structure. It was written in the question as well that combined company's capital structure, the debt to equity composition, stays at pursuit's current capital structure, 50-50%. Combined capital structure 50-50 stays at same pursuit's level 50-50. So now you don't need to worry that I don't know what to do in the first line. We will get the solution, but firstly you have got a crystal clear line of action in you that you need to use the free cash flow to company method to estimate value of further and combined company. Okay, so I will start the question, opening my response. Free cash flow to firm method shall be used to estimate value of further and the combined companies. I'm first doing further. Free cash flow to firm method to estimate value of further. Free cash flow to firm method to be used to estimate value of further. Okay. Now again to score marks. Again to score marks. You are using free cash flow to firm, that is free cash flow to company method, to estimate value of further. You're using free cash flow to company method to estimate the value of further. Now let's suppose you don't know anything. Still, you should first make the format of free cash flow to firm method. This will also secure marks for you. Make the format free cash flow to firm method. You have decided as per the requirement the free cash flow to company method shall be used to estimate value of further. use the free cash flow to firm method format. Let's start with sales. Okay, from sales we deduct cash cost, then we deduct TAD. So we reach operating profit. From operating profit we deduct interest. So we get taxable profit. From that taxable profit we pay tax. Okay, then we add back TAD, then we deduct investment in working capital, investment in non-current assets, we get FCF to company. We apply discount rate, WACC, we get value of company. Okay, okay, so we need to use free cash flow to firm method to estimate value of fodder and the combined company, but I will firstly do free cash flow to firm method to estimate value of fodder. Now, whether you know anything or not, the first thing I advised all of you that if the question asks you to use free cash flow to firm method to estimate value of fodder, even if you don't know anything, just make the format. Okay, the free cash flow to firm method format starts with sales. We then deduct cash costs. Then we deduct TAD. I told you one thing, we reach operating profit. We pay interest. So we reach taxable profit. Then we pay tax. Okay. Then we add back TAD. Then we deduct investment in NCA. Then we deduct investment in working capital. We get FCF to company. We apply discount rate. It's WACC here. We get value of company. Okay. We then deduct value of debt. We get value of equity. This is where it stops. So no matter you know the workings or not, the first important thing is to make the format. See, we had a format here. Revenue less cash cost TAD reached operating profit, then interest, taxable profit, then tax, add back TAD, less an investment NCA, and investment in working capital. We get FCA. Discount rate back, we get value of entity, the company, deduct value of debt to get value of equity. Okay, now Or the cash costs are any cost like cost of goods sold, material, labor, etc. Okay, now let's start the question. In FCF method, we first need to record sales. Now remember, as per this method, the FCF method, as per the FCF method, see the first line. The value of business is worth the discounted value of future free cash flows. As per this method, the worth of the business is the discounted value of future free cash flows. Remember, you have to take all these values for the future, not for this year, because that's the requirement of free cash flow to company method. That value of business is equivalent to the future cash flows. So we need to use the cash flows for the future. Now, how many years future means, I have no idea, you have no idea. It entirely depends on the question. That in free cash flow to firm method, once you have made the format, the value is equivalent to future cash flows. So we need to write all these cash flows for the future, starting from sales. We have to look at the question, how many future years are given? Sometimes 2 years, sometimes 3 years, sometimes 4 years, sometimes infinite years. So you need to take all these values for the future. I'll go back to the question. See, in this, we are finding the value of fodder. So I will only look at the data of fodder, right? I'm finding the value of fodder. So I will only look at the data of fodder, no other data. Look at the last paragraph. For the next 4 years, fodder's revenue will grow at same rate as previous years. For the next 4 years, fodder's revenue will grow at same rate as previous years. That's 6%. So for the next 4 years, revenue will grow at same rate as previous years. So you are given for the next 4 years, revenue will grow at 6%. This is how you get information about the future. You're given 4-year data. For the next 4 years, the revenue will grow at same rate as previous years, 6% for the next 4 years. Okay, so increase revenue for the next 4 years by 6%. Increase revenue for the next 4 years by 6%. So what is the last revenue? What is the last revenue? It's 16146, right? Last revenue is 16146. For the next 4 years, it will increase by 6% per year. So increase this 16146 by 6%, 1.06. Okay. And then I3 multiply by 6%. Okay, and you can then drag it. So for the next 4 years, the question states that fodder's revenue will grow at the same rate as previous years, 6%. So 17114, 18141, 19231, and 20383. Okay. Why did I take 4 years? Remember, why didn't I take current revenue? As per the definition of FCF method, the value is based on future FCF, not the current ones. Okay. So we need to take future. I don't know whether the meaning of future is 2 years, 3 years, or 4 years. It will give me information. The question stated that for the next 4 years, revenue will go at the same rate as previous years, 6%. So increase by 6%. Okay. Any problems with this? revenue. A lot of questions about interest. Just wait patiently. See what we are doing here. Okay, just wait. Now, after revenue, you need to deduct cash costs and TD. After revenue, you need to deduct cash costs and TD. When I go back to the question, there is no cash cost or TD given. Direct operating profit is given. There is no cash cost or TD given. Direct operating profit is given. Okay, 5169. So what I will do is, I will also not write cash cost and TD, just write operating profit. What is the percentage of operating profit? It's 5169 divided by 16146, 32%. Okay, and this operating profit comes after deducting cash cost and TD. So since the question hasn't provided any information about cash cost and TD, I will also ensure the same thing. I won't write cash cost and TD. Direct reach operating profit, which is 32%, because that's after cash cost and TD. Okay. So here, 32%. I3, 32%. Okay. And you can drag it on. It's 5477, 5805, 615465, 23. Okay. So where did cash cost and TD go? They're already deducted. They're already deducted because I came to 32%. So 68% was deducted. Why did I use this strategy? Had the question provided me cash cost and TD information, I would have used that. But the question didn't provide me any information about cash cost and TD, so I can't use it myself. I can't write cash cost myself. The question also mentioned in the format. See the format of the question, that once you take revenue, it isn't writing cash cost and TD. It is only taking operating profit and believing that after operating cost and TD. So I took the operating profit percentage, that's 32%, and when 32% is taken, cash cost and TD deducted. Okay. Interest, I needed to write it in the format while making, but you know in FCF2 company method, interest doesn't come, so it's 0. There are 8 to 10 messages on just this. Why did we take interest? Should wait. What we are doing, there's no interest. Okay, so you get taxable profit. Taxable profit is the same, that means I6. And drag it on. So on this taxable profit, we have to pay tax. And what is the tax rate in the question? 28%. So pay tax at 28%. Tax is supposed to be an outflow, so minus I8, sorry, 28% equals to, okay, and we drag it. So any questions till tax, please? Okay, so I have requested many times that if a person is unable to hear my voice, that's an issue at his end, because there are 100+ students taking the class. All would have faced problem if the problem is from my side. So I just open the messages, and there are 6 to 7 messages of a single student. No voice. It's your end here. It's not my end. Okay. There's no problem from my end. Otherwise, everybody would suffer. Okay. So check your connectivity issues, please. Minal, your questions replies that as per the definition of FCF method, value is based on future FCF. So all these things, the FCF you are recording, that should be for future, not the current ones. So Faisal, your situation is obviously all right. Okay. And in that case also, we will read the same answer, right? I find working capital, I have to find it's same as TAD, and the cash cost would be the balancing figure, but it would be same as answer. Okay, question from Asan Jawad. Why did we take operating profit percentage of 2011 and not other years? Okay, the basic assumption is that most reliable data is the latest data. Let's suppose you have to plan something for the future in your personal life. Which data will you rely on, 2020 or when you were a kid of 2010? Obviously 2020, latest data is relevant. Yes, Preeti. Sri Kotale, I will send it, don't worry. I can't leave the class and send it on WhatsApp groups. I will send it in the break, don't worry. Operating profit is just if and what 32% of revenue, because operating profit is a percentage of revenue. We computed it for 2011, profit over revenue. Jakir, we discussed yesterday in FCF to company, interest doesn't come because it's already included in WACC. Meanwhile, it doesn't seem possible here. Meanwhile, I explained yesterday that since interest is already included in WACC, the discount rate. So since you're using WACC, if you take interest here again, it would be double impact. Now we're taking 32% because it was not given. The cash cost and TAD weren't given, right? Now I have been seeing 2 or 3 very funny questions. So just wait a second, please. In the question, cash costs and TAD weren't given. In the question, cash costs and TAD weren't given. Okay, directly operating profit was given. So we also would write directly operating profit. Now operating profit is what? Operating profit is basically a percentage of revenue. So I went to the last year, took operating profit percentage, which is operating profit over sales. It's coming 32%. So I also took 32%. Okay. Asan, that's what I'm trying to explain it to you. Operating profit percentage may be different each year. What is the most reliable data? If you consider the most reliable data is the latest one, which it is, that you can plan for the future, assuming the current is the latest. So you will have to take the latest percentage. Yes, Asan. Shilpa, what are you trying to use this formula for? Now, Aman Batra, your question seems funny to me, that if we had FCF to equity, what would be the interest? Obviously, then interest information would have been provided by the question, that what is the rate of interest and what is the stuff like that. However, since this question isn't of FCF to equity, that's why it hasn't provided any information about interest. Shilpa, you can use that. Okay, now you need to add back TAD, investment in NCA, and investment in working capital. Three things remain. Okay, so add back TAD, tax allowable depreciation, and working capital. Now listen to this point carefully. Okay, I don't know what tax allowable depreciation is because I wasn't provided information about that. Okay, and I didn't know what TAD was. Okay, but it doesn't matter what TAD is here, because the question asks you to assume that TAD is equal to the working capital. Remember this red line amount, assume tax allowable depreciation is equal to working capital. So TAD is equal to working capital. So that's why TAD is added here and investment in working capital is subtracted here. Okay, it would offset. So you can write nil nil and deduct nil nil. Why did I write 0, 0, 0, 0? Because TAD was equal to working capital. One thing is adding and working capital is deducting. Let's suppose you know what TAD is. Let's suppose you know TAD is 500. What would be the difference? If TAD is 500 each year, add 500, 500, 500, 500, and then it's same as working capital. So deduct 500, 500, 500, 500. What impact will it make? 0. Let's suppose you know the TAD it's 1000. No difference. If it's 1000, you write 1000, 1000, 1000, 1000. You added it, 1000 each, and then you deducted 1000, 1000, 1000, 1000. The 1000 add and 1000 deduct. It cancels. So there is absolutely no need. Whenever TAD and working capital are the same, you can write 0, 0 because it gets offset. Okay. Investment in NCA. What is the information about investment in NCA? Look at the second last paragraph. Fodder will require an additional investment in assets of 0.22 per $1 increase in revenue for the next 4 years. You need investment of 22 cents per $1 increase in revenue. You need investment of 22 cents per $1 increase in revenue. Okay. So the revenue is increasing. From 16146, okay, and it's becoming 17114.76. Okay, so it's becoming 17114.76. From the last one, 16146. This difference made it the increase in revenue, and 0.22, 22 cents per dollar when increase in revenue. So this is the investment in non-current assets. You took the difference in revenue 16,146 to 17,114. Okay. And this is the difference in revenue, the increase in revenue, applied 22 cents on it. Look at the formula. 176 was the revenue. The previous revenue was 16146. Take the difference, increase in revenue, apply 22 cents. Okay. Here, what is the difference in revenue? J3 18141 minus I3. This is the difference in revenue. Okay, and apply 22 cents. Here, the increase in revenue. So K3 minus J3. The difference is the increase in revenue and apply 22 cents. And here the increase in revenue is minus bracket open L3 minus K3 into 22 cents. Okay, so additional working capital investment in non-current assets of 0.22 per dollar when increase in revenue. So it just took the difference to get increase in revenue and applied 22 cents. Okay. All of this led to FCF2 company. So FCF2 company would just be the sum of taxable profit deduct tax I8. Taxable profit, you deduct tax and everything to I12. And you can drag it off. So you've got FCF2 company, future FCF2 company. Okay. Any questions up till now? Mohammed Yunus, workings are necessary. Unless you ignore the workings, you will lose marks. If I am unable to see 171 anywhere, so please tell me where is 171. Shilpa, the only solution is practice. Practice more and more. Okay, investment in working capital is zero if INVA because TAD was equal to working capital. Now, if you see TAD is added and working capital is deducted. So if I write, let's suppose 500 investment in TAD, and then I need to deduct investment in working capital, that's the same 500. The effect would be zero. So that's why I took it 0, 0. If you want to write any number, you can write it as per your choice. But whatever TAD you wrote, it will be deducted as working capital because they are same, and ultimately will end up towards the same answer. Almir, we haven't moved towards WACC, so I am unable to answer you at the moment why we aren't using that model. You should see which model we use because we haven't computed WACC now. Now, if we go to the question, look at the last paragraph. For the next 4 years, Fodder's revenue, for the next 4 years, Fodder's revenue will grow at the same rate as previous years, 6%. After the forecasted 4-year period, the growth rate of free cash flows will be half, 3% for the foreseeable future. Now, after 4-year period, the growth rate of revenue is not given. After 4-year period, the growth rate of free cash flow is given. It will be half the revenue growth to 3%. So for the foreseeable future, now this sounds interesting. We believed that we had been provided information for future till year 4, but everything was provided till year 4. We wrote it till year 4. But after 4-year period means 5. After 4-year period means 5 to infinity, foreseeable future, 5 to infinity. The growth rate of revenue isn't given. It didn't say that the growth rate of revenue will be 5%, 3%. From 5 to infinity, the question stated the growth rate of free cash flow will be half, 3%. So for the foreseeable future, the growth rate of revenue, had it told me revenue, I would have made it revenue. The growth rate of FCF, where is FCF? In L13 will be half, 3% for the foreseeable future. So I made it 3% for the foreseeable future, the growth rate of FCF. So now the future data is for infinite number of years. A question arises, why didn't we increase revenue? I'm just following the question instructions. Okay. The question instructions say that for the next 4 years, revenue will grow by 6%. So I increase revenue till 4 years. After 4 years, the growth rate of cash flow will be half, 3%. So I increase my cash flows. Okay. Now this is all about FCF to company. Now we need to multiply it with discount rate WACC to get value of company, and we deduct value of debt to get value of equity. Okay. Now about discount rate WACC, we need to compute WACC here. We need to compute WACC for Fodder. So look at Fodder's information. Please pay attention. So Fodder has a debt to equity composition of 1090. Fodder's debt to equity composition is 1090. Okay. Equity beta 1.53. It is anticipated that Fodder will pay interest at 9% on borrowings. So interest on borrowings, which we call KD, 9%. Okay. You can find WACC for Fodder. Okay. KE into equity proportion of the company plus after tax cost of debt into debt proportion. Okay. So you know that equity proportion is 90. After tax cost of debt, the interest rate is 9%. After tax 1 minus 0.8. It's 10 over 90 plus 10. You just need to find K. So obviously we will find K through CAPM, the capital asset pricing model, which states K is risk-free rate plus market rate minus risk rate into beta equity. Government base rate, risk-free rate is 4.5%, premium is 6%. Government rate 4.5%, premium is the whole bracket 6%. And what about beta equity? 1.53. Okay. KE becomes 13.68%, and we put this here to get Fodder's WACC. Approx 13%. Okay, this will be used as discount rate. You can copy the screen for WACC so that I can move towards the remaining portion of the question. And if you have any questions with WACC, you can ask. No, Abdul Wahab, foreseeable means infinite years. Osman, had the revenue been increasing, we would have increased revenue. If any other question states after 4-year period, so after 4 year, what does mean by after 4 years? After 4 year means 5th year. The revenue will grow by 3% for the foreseeable future. So after 4th year, which means 5 years, the revenue will grow by 3% for the foreseeable future. So 5 to infinity. Almir, in capital asset pricing formula, beta equity comes, not the asset beta comes. So since beta equity was given, there is no need to find asset beta. Abdul Wahab, you are right. In audit and accounting, foreseeable future is assumed 12 months, but you are not studying auditing and accounting here. You are studying financial management. Ahmad Junaid Makra, the question about working capital is released at the end of life. That is an NPV assumption. We are not computing NPV here. Abdul Wahab, you're talking about going concern. We are not studying it here auditing. That's why you can't apply audit assumptions here. Cost of debt, Agnes, is the cost of borrowing. You cannot take 4.5% the risk-free rate. The borrowing rate is the cost of debt. Shilpa, that's when you compute market value of bonds. Otherwise, here in WACC, it's after-tax cost of debt. Abdul Wahab, you are asking why not calculated the beta asset for calculating KE. Now remember the formula is KE is RF plus RM minus RF beta equity. You need beta equity, you don't need beta asset. So since beta equity is given, why do you need to calculate beta asset? There won't be any use of beta asset. It doesn't come in KE formula. Jacker, RM or RM minus RF, they will always be given, never used to calculate. Jagat, as far as ungoverned rigor is concerned, that's only involved in case of diversification or change in capital structure. If FNWA 13.68 was RF 4.5 plus the premium 6% into 1.53, we get 13.68. Arun, it would give the same answer. You can check. Meanwhile, I will send it in a day or two. No Salima in FCF, nothing else comes. Yes, Preet, the formula of K is RF plus RM minus RF beta equity. So we always use beta equity in CAPM formula. Okay, so now since we got WACC of 13%, we just need to apply discount rate WACC 13% here. So the factors will be in discount tables which are provided to you. I'm seeing 13% year one is 0.885. Okay, then 13% year two is 0.783. Then 13% year three is 0.693. And 13% year four is 0.613. Okay. These discount rate of year 1, 2, 3, 4 came from the table, but remember from year 5 to infinity or 6 to infinity or 7 to infinity or 8 to infinity, for infinity the table is not there, the factor is not there in the table, so we apply a formula of last discount factor over WACC minus growth rate. Okay, since we needed a discount rate of 13%, so 13%, we needed factors for year 1, year 2, year 3, and year 4. We got the factors of year 1, 2, 3, 4 from the table, but as far as this 5 to infinity or 4 to infinity or 3 to infinity or 8 to infinity is concerned, we don't have the factors of these in the tables, so we apply a formula, last discount factor. What is the last discount factor? 0.613 over WACC minus growth rate. So what is WACC? 0.13, 13%, minus what is the growth? 3%. So last discount factor over WACC minus G means it makes it 6.13. Last discount factor was 0.613 over WACC 13% minus 3%. Okay, this made it 6.13. Okay. Now you need to multiply this FCF by the discount rate to get value of company. So you can just take this I13, multiply by discount factor I14. You get the present value and you can drag it on. Okay. The FCF to company multiplied by the discount rate gives value of company, present values. Okay. You need to add them all. Total present value of all future FCF. That is called value of company as per this method. The total present value of all future FCF. That's called the value of company. So you just need to sum the present values of all future FCF, I15 till M15. The present value of all future FCF. This is the present value of all FCF. We get value of company, deduct value of debt. So debt in this company was 10%. The debt of this company was 10%. So deduct 10%. What is the 10% of this? K16, sorry, K17. Derek, 10%. You will get value of equity. Deduct it. $3,606,7. Now I'm just repeating it from FCF. We get the future FCF multiplied by the discount rate of WACC 13%. The factors of year 1, 2, 3, 4 are given. For infinity years, no factor, last factor over WACC minus growth rate. You get present values. Okay. Add all these present values. Add all these present values. The total of all these present values is the value of company. Deduct value of debt. That is 10%. You get value of equity. Okay. So after this, we will be taking a break, and the break will start once I'm done with your questions. So if you have any questions regarding this, please ask. Then we will move towards the break. Okay, so now let's take the questions. If in we are using the normal CAPM formula, RF plus RM minus RF beta equity, the only difference is that I wrote beta equity after the bracket and you are writing it before the bracket. They produce the same answers. Sandon, you can go back to Fodder's question. It was written the debt to equity ratio is 1090, 10% debt. Discount rate for Infinity Prepay is always last discount factor over WACC minus growth rate. M14 is last discount factor over WACC minus growth rate. Abdul Wahab, we have already taken the inflated value of 3%. For Ashik, doesn't make any difference, 28050, 28060. No, Usman, if sales are increasing, then obviously it will give you information about profit because sales create profit, the tax, everything. Almir, where does dividend growth model come from in FCF? Oda, I can't get your question. Please elaborate a bit. Meanwhile, if you think that you have applied one formula and in on future cells, the formula would be the same, then you can drag it. Yes, Almir, you can consider it that the growth model formula is same in that. Okay, so I've answered all questions and we will be taking a break and then meet. Okay. You're welcome, Milovan. Okay, let's resume the session. No, Basna, we don't have to use annuity tables. We just have to use the discount tables. Year 1, 2, 3, 4, and for the last one, last discount factor over WACC minus growth rate. Okay, now the question asked us to use FCF to company method to estimate value of fodder and the combined company. So I have used the FCF to company method to estimate value of fodder. Now I want to use FCF to company method to estimate value of combined company. Okay, now I want to use FCF to company method to estimate value of combined company. Okay, so before that I had used FCF to company method to estimate value of fodder. Now I want to use FCF to company method to estimate value of combined company. Now let's start using FCF to company method to estimate value of combined company. Now before using FCF to company method to estimate value of combined company, I have to use or read the information of combined company, right? Obviously, when estimating value of fodder, you use the date of fodder. But when you're estimating value of combined company, use the date of combined company. Just giving you a minute, please read the information of combined company. Okay, so the question states, maybe you have read the information in this, because when we plan to do this stuff that we are finding value through FCF method, estimate the value of fodder in the combined company. When finding value of fodder, we use the date of fodder. When estimating the value of combined company, we are using the information of combined company. Now, following the acquisition, it is expected combined company's revenue will be 5195 in first year. Its profit margin on sales, that's operating profit margin, will be 30%. After the first year, the growth in revenue will be 5.8% per year for the following 3 years. Following the acquisition, it is expected combined company will pay interest at 6.4%. Combined company will require additional investment in assets of 513,000 in first year, and then 18 cents per dollar when increase in revenue. It is anticipated that after the forecasted 3-year period, its free cash flow will be half the revenue growth rate. So after the forecasted 4-year period, the free cash flow growth rate, not the revenue growth rate, will be half the revenue growth rate. That's 2.9%. It can be assumed that the asset beta of combined companies, the weighted average of individual companies' asset betas, weighted in proportion to their market values. Okay, now pay attention, please. If I intend to use FCF to company method to estimate value of combined company, if I intend to use FCF to company method to estimate value of combined company,
What is the combined company's revenue in first year? Now I need to take the information about combined company. So combined company's revenue is 51952. So I wrote 51952 in the first year. Okay. And after the first year, the growth rate in revenue will be 5.8% for the following 3 years. For the next 3 years, it is going to increase by 5.8%. So 1.058 and drag it. Okay, so 51952 in the first year and increasing by 5.8% per year. So 5.8% per year increase, it's 51952, 54965, 58153, and 61526. No cash cost area were given, and its operating profit margin will be 30%. So I can make it 30% and just multiply all this stuff by 0.3 and drag it. Interest doesn't come here. Okay, so we get taxable profit, that is 15585, 16489, 17445, 18457. On that we paid tax at 28%, so 28% taxes. For 364, 4617, 4884, and 5168. Now, because of spreadsheet, all the formulas were feeded, so it is saving me a lot of time. Now, a very interesting thing is that one student messaged on WhatsApp group that Excel saves a lot of time, and it is very disadvantageous for paper-based students compared to Excel students. Now, I'm telling you a very interesting thing. Those students who are giving paper on Excel suddenly compared to paper-based, they want paper-based, and those who are giving on paper-based, they want Excel. So it's just a matter of your taste. Anyways, I have done till tax. If you have any problems till tax, please let me know. If you have any problems till tax, please let me know. If NY wrote the formula last discount factor, that is year 4 over WACC 13% minus growth rate 3%. Maybe I wrote it here as well. Last discount factor over WACC minus. FCF after 4 years was increasing by half 3%. So I just increased it by 3%. Okay, now on taxable profit, we paid tax. Now after tax, it's TAD and working capital. So you can see in the formula of this the information about combined company. There was no information about TAD and working capital, so we have to assume it's the same. There is no information about TAD and working capital, so we assume it's same. That's 0, 0. Investment in NCA. How do we get investment in NCA? The question stated, combined company will require additional investment in assets of 513,000 in first year. So our first year is 513,000, and then 18 cents, 0.18 per dollar one increase in revenue for the next 3 years. So 513 for the first year minus 513, and then every $1 increase in revenue 18 cents. So how much has the revenue increase? It's J3 minus J2, right? This is the increase in revenue, the difference, and on that we apply 0.18. Okay, then increase in revenue is K3 minus J3, 0.18, and then it's L3 minus K3, 0. Okay, so till year 4 we got FCF, till year 4 we got FCF, and after year 4 the question states it is anticipated that after 4-year period. What does after 4-year means? 5 years. After 4 years means 5 years. Its free cash flow growth rate will be half the revenue growth rate. So half the revenue growth rate is 5.8%. It's going to be 2.9%. So after 4-year periods means 5 to infinity, the growth rate will be half the revenue growth rate, 2.9%. This is what we got about FCF. Any questions to FCF2 company you can ask, and we will move towards WACC, which is going to take some time. Sadafzara, I just read your message on WhatsApp group. So basically, this platform does not include complete Excel functions. Okay, so you won't have all Excel options available on this practice platform. So better practice on this platform. Everybody knows that Excel has everything, therefore it is likely to be more better. But in exam, Excel is not allowed. This spreadsheet function is allowed. Whatever functions are being allowed by this platform, that will be allowed in your paper. If INVA, I haven't calculated anything in that. It's just the information of the question that after 4-year period, the revenue growth rate will be 3%. So after 4-year, I just increased the cash flow growth rate, sorry, not the revenue growth rate, but 3%. There is no calculation involved. It's just what question says. M13, and I have opened the calculation. It's just after 4-year periods, the revenue is increasing by 0.5% of revenue. So revenue was 5.8% growth. So half the growth rate means 2.9%. It's the difference in revenues if involved, like we did in the last further company question. The growth in revenues by taking the difference and multiplying by 18 cents, 0.18. No marks for that, Shilpa. Meenal, you can watch these Excel videos on YouTube because they're available, because I can't leave the question. I'm sorry to explain the functions difference, so I really apologize. So now we have got the FCF2 company. We just need to discount it by the WACC. So what is the WACC here? Now you need to pay attention to WACC. Now we need to find the value of combined company. Therefore, we need the combined company WACC, right? We don't need the father's WACC or the pursuits WACC. We need the combined companies WACC. Okay, so let's see if the question is giving combined companies WACC. There is no information about combined companies WACC, so we need to find combined companies WACC now. The equation of WACC is KE, cost of equity, into equity portion of the company, plus the after-tax cost of debt, KD1 minus T, into debt proportion of the company, right? So what is the capital structure of the combined company? The question is clearly mentioned that you need to assume that the combined company's capital structure remains at Pursuit's current capital structure. It's written in the requirement and in the question as well that you need to assume that the combined company's capital structure remains at Pursuit structure level. So Pursuit structure is 50-50. Combined capital structure will remain at Pursuit's level. Okay, combined capital structure will remain at Pursuit's level. So 50-50. Now we need after-tax cost of debt and K. So it's written in the question that following the acquisition, it is expected that combined company will pay interest at 6.4%. So interest rate of combined company is 6.4%, the cost of debt. Make it after tax. Okay. Now finally you need combined company K. Finally you need combined company K. So what is the formula of K? RF plus RM minus RF times beta equity. Now I need you all to pay attention on it. Okay, the combined company is RF plus RM minus RF beta equity. So what is the risk-free rate? The government base rate 4.5%. The premium 6%. Now you need beta equity. Beta equity of whom? The combined company. Obviously, you are doing everything for combined company. When you were calculating Fodder's WACC, you needed beta equity of Fodder. Pursuit, beta equity of Pursuit. But here you are using combined WACC, so you need everything for combined company. Combined capital structure was 50-50. Combined borrowing was 6.4%. You look at after tax. Combined K is RF plus RM minus RF beta equity. Okay. So what is the combined beta equity? If we go to the question, this is the information about combined company. There's no information about combined beta equity. But read this last line. It can be assumed that the asset beta of the combined company is the weighted average of individual companies' asset betas weighted in proportion to their market values. It's a very important thing. No information about beta equity of combined company. We need information about combined beta equity. There is no information given. It states beta asset of combined companies is the individual company's beta assets average. So what is the individual company's beta assets? So individual beta asset of Fodder is beta equity of Fodder is 1.53 and beta equity of Pursuit is 1.18. The question states it can be assumed not the beta equity. Beta asset of combined companies is the weighted average of individual asset betas. Beta asset of combined company is the weighted average of individual beta assets. We don't have individual beta assets. We have individual beta equities. We don't have individual beta assets. We have individual beta equities. So we will first ungear them to get individual beta assets. You know the equation given in the formula sheet as well. So beta equity of Pursuit is 1.18 and the debt to equity composition is 50-50. Right? No beta that is given, that's why I take it 0. We will get beta asset. .68, right? We need combined beta equity, this highlighted one. No information about combined beta equity is given. In fact, it states that you assume that the beta asset of combined company is the weighted average of individual beta assets. I don't have individual beta assets. I have individual beta equity, so I need to ungear to get individual beta assets. 1.53 into 90 over 90 plus 10, 1 minus 0.28, no beta that given 0, so beta asset here it becomes
1.41. I've still not got the combined beta equity, but the question told me that you need to assume that the beta asset of combined company is the weighted average of individual beta assets. So I needed individual beta assets first. So here I had individual beta equities. I firstly ungeared them to get individual beta assets. Now you need to copy this so that I can move forward. And if you have any questions till individual beta assets, the first question, why I computed individual beta assets? It was written in the question that beta asset of combined company is the individual weighted average of beta assets. So I had beta equity of individuals. I computed beta assets of individuals. Copy this, and if you have any questions up till now. Whenever you have to get beta asset, Darren, you need to ungear. Okay, so the question stated, now we are stuck here that we need combined beta equity. There was only information about combined beta asset, that combined beta asset of individual companies is the weighted average of individual beta assets. So I got individual beta asset. Now it states combined beta asset is weighted average of individual beta assets. Combined beta asset is the weighted average of individual beta assets. Okay, so what are the individual beta assets? 1.41, 0.68. Combined beta asset is the weighted average of individual beta assets. See the question. It can be assumed that the asset beta of combined companies weighted average of individual asset betas, weighted in proportion to individual market values, weighted in proportion to individual market values. Okay, so the combined beta asset is the weighted average of individual beta assets. That means individual beta assets 1.41 plus 0.68. Combined beta asset is the average, weighted average of individual beta assets. So obviously combined beta asset will be the average merger of both beta assets, but weighted in proportion to their market values. What are their market values? The market value of this is 40 million approx, and of this is 140 million approx. It's given 140 million for pursuit and 40 million approx for fodder you just computed before break.
So individual beta assets average weight in proportion to their market values. The market value of fodder is 40 over total, and for pursued it's 140 over total. For fodder it's 40 over total, and for pursued it's 140 over total. .84. This is the combined beta asset. Now I'm repeating it. How did I know I needed the individual beta asset? Now the question has to get combined beta asset, and it has only given one information, that the beta asset of combined company is the weighted average of individual beta assets. I didn't had individual beta assets. I first had individual beta equities. So I firstly calculated the individual beta equities from beta assets from beta equities and get. Now the combined beta asset is the weighted average of individual beta assets. So I added both assets and applied the weights of their market values. 140 million for pursuit, that was given, and 40 million approximately. I didn't take the exact one which I just calculated. I took the 40 million which I just calculated for fodder. So now I got the combined beta asset. Any questions on this combined beta asset? It's the weighted average. That means total of both, but just apply the weights of their individual market values. $140 million is the market value of pursuit. That was given in the question, you can check. And 40 million approximately is fodder, which we just calculated before the break. Yes, Almir, your question is right. If there is one mistake, you still get marks for the other parts if they are correct, or other steps if they are correct. Yes, Rumbedzai, you are right. You should proceed to the next step. Amdi Fazlul, I only did this because it was stated by the question that beta asset of combined company is the weighted average of individual beta assets. So combined beta asset is the weighted average of both beta assets. weighted in proportion to their market values. The question told us that you need to weight them in proportion of market value. So just weight them in proportion of their market values, 140 and 40. You just copy this stuff. So I will then move the screen up so that we go towards that portion. But at the moment, we got individual beta assets. And as per the instruction of the question, the combined beta asset is the weighted average of individual beta assets. So we made it the weighted average of individual beta assets and applied the weights of market values. Now, again, the main question was that, listen this thing carefully. You still need combined KE, RF plus RF minus RF beta equity. You need combined beta equity. Question didn't give any information about combined beta equity. It just gave that combined beta asset is the weighted average of individual beta assets. So you got individual beta assets, weighted them to market values, you got combined beta asset, but still that doesn't work. You need combined beta equity. So if you have combined beta asset, you can easily find combined beta equity by regearing. So you have combined beta asset, you need combined beta equity. Combined beta asset is 0.84, you need combined beta equity. And what is the capital structure of combined company? Is the same as pursuit, 50-50. No beta that given 0. So from combined beta equity, combined beta asset, sorry, you get combined beta equity as 1.44. And that's it. That's what was missing, the combined beta equity. We placed 1.44 here. We will get the combined K, 13.17%. Here you get the combined K, and that was what was missing. We had the combined E&D, combined beta debt, but only combined K was missing, and for that we have to perform a hell lot of calculations. We had no information about combined beta equity, so we found combined beta asset and then re-get it to get combined beta equity. Once we get combined beta equity, we get K. Okay, so once you got the combined KE, that's what was missing, because we had the combined WACC, the E&D, the KD, just the combined KE was missing. That was 13.17%, so we get the combined WACC as 9%. Okay, so hopefully through this question, we got a major help that we didn't only covered mergers, but also got to know some information, although not complete information. I tried my best, but WACC, because that's the maximum WACC can be tested. Jakir Hassan, if you get combined beta acid of 0.84, where would you place that combined beta acid? Because the formula doesn't mention combined beta acid, it mentions combined beta equity. In RF formula, we have to take beta equity, not beta acid. Yes, definitely, Blaine, you will lose marks. Usman Qureshi, market value of fodder is the one we calculated before the break, 40075 something. So I took it as 40 million. It's 1.44. Faisal. Okay, so once you get to this combined WACC of 9%, you just have to go and repeat the stuff which you did before. Now pay attention. FCF2 company of combined company, we got it. Discount rate WACC, that's 9%. Now pay attention, please, so that previous confusions are also resolved. Now 9% factors can come in the table. I'm just opening the table. The factors of 9% year one is 0.917. Okay, of year two, 0.842. Of year three, 0.772. Of year four, 0.708. And again, 5 to infinity, last discount factor, 0.708. WACC minus growth rate. So what is WACC? 9% minus growth, that is 0.029. Remember? 2.9%. 11.6. So this is what we got present values. We add them all, the present value of all future FCF. By definition, this is the value of company. deduct value of debt. Now the debt is not 10% for combined company, it's 50%. So get 94531 as the value of equity of the combined company. Okay, any questions? I-14 cell. And this is discount factor 9%. We don't calculate it. We take it from the present value tables provided. When since the last discount factor, the last year over WACC 9% minus growth 2.9%. SN obviously dividend will be relevant for dividend valuation model, not the FCF method. In the format, dividend comes nowhere. Our decision is based on value of equity. Because if we take Salima value of company, you have to still pay debt out of that. So value of equity is what that remains. Winston, M14 is the last discount factor. And L14 over WACC 9% minus growth rate 2.9%. Faisal, your working might be wrong. So you are not using the calculator, all right? It's 0.708 over 0.09 minus 0.029. So you should place the denominator in bracket. Troy, this is the combined beta asset working for you. Yes, Chakra, you have to. Yes, Salima, calculations come in appendix. Okay, now the question has asked you one final thing, because in part A, the question asks whether acquisition of fodder would be beneficial for pursuit. Whether acquisition of fodder would be beneficial for pursuit. You need to decide whether acquiring fodder is beneficial for pursuit. Whether acquiring fodder is beneficial for pursuit. We didn't know initially what to do with this. We had no idea what to do with this. But the question later mentioned the free cash flow to company method should be used to estimate value of fodder and combined company. Okay. So initially it said that the free cash flow to company method should be used to estimate value of fodder and the combined company. So we use the FCF method to estimate value of fodder and combined company. Now the question is asking whether acquisition of fodder is beneficial for pursuit. Now it's just 1 or 2 marks whether acquisition of fodder is beneficial for pursuit. An acquisition is beneficial if it creates synergy, means more benefit, more value than combined ones. So remember, the individual value of pursuit was around 140 million given in the question. The individual value of fodder was not given, you calculated 40075 approximately 40 million. Okay, and combined company value you just calculated approximately 189 million. So see, the individual values are 140 and 40. After combining, it should be 180, but it's becoming 189. So is the acquisition creating some synergy? Yes. So acquisition, since creates synergy, most probably it is likely to be beneficial. However, it also depends on how much premium has to be paid, because payment of equity value over 25% premium. That's what they're saying. So if they're asking for more premium, then obviously it would be net loss. But given the synergies rating, then obviously the acquisition is likely to be beneficial. Okay, please copy. Any questions? Yes, Shilpa, you're right in your question. Milovan, you are right. It's too much workings for 16-mark question. But unfortunately, in classes, we complete the whole question, and here we have limited time. We are unable to complete remaining parts. Just trust me, remaining 20 marks are very, very less time consuming, and they are quite easy and less work for 20 marks. So it creates a balance. Minal, I can't answer you which is important. Both methods are equally important. It's what just the question demands. Almir, where is 38086? I am not getting where is 38086. Market value is always both equity and debt. If in, I will do it after class. I can't do in between the class. I will do it after the class. Don't worry. M14. Wait a minute, Jakir. M14 is I've written the formula as well. It's the last year's discount factor over WACC minus growth rate. I've written it again. Yes, Mino, you can write the workings in Word as well. Yes, Elmir. It's 25% premium above the equity value. So you need to take the equity value, 94531, and 25% on that. I'm just running out of time. So one last thing, part B, limitations, also called assumptions of this valuation method. Now, in this valuation method, there are some assumptions like cash flows are expected till perpetuity. And perpetuity means infinite number of years. You can't get the number of years. So cash flows continue till perpetuity. Tax rates are assumed constant. Operating profit percentages assumed constant for foreseeable future. Combined beta asset weights on market values. See, it's written. Some assumptions are general, but some are given in the question. It can be assumed. See this highlighted thing? It can be assumed. Another thing, it can be assumed that TAD is equal to working capital. It's written in the question. It's assumption or limitation, TAD equals working capital. So some things are given that it is assumed, just copy paste that. And some assumptions are genuine, like cash flows are working till perpetuity, tax rates are assumed constant, discount rates are assumed constant, operating profit percentages is assumed constant. So these are some assumptions which you need to write to earn some solid marks. Okay. Jakir, the discount factor of annuity is the last discount factor. Last discount factor means year 4 factor. It's 0.70. So last discount factor over WACC. What is WACC? 9% minus growth rate 2.9%. This is how you get the answer. And if your calculating is producing wrong answer with it, you are not applying the formula correctly. This should come in bracket. So it's 0.708 over 6.1%. Amsal, this is also an assumption that combined capital structure is equivalent to TAD. Sorry, is same as pursuit level. So see, 3 assumptions are given in the question, that combined capital structure is equal to pursuit's capital structure, TAD is equal to working capital, operating profit margin remains constant. Now, before signing off, last 2 minutes before signing off. Now see, these sessions are developed for you, and ACCA doesn't charge you anything for the session, to just get a good idea of how these sessions work, and specifically for those students who suddenly had to face the remote exams due to this scenario, and they suddenly knew that they studied according to paper based and suddenly they have to give an Excel. I was specifically told by ACCA to conduct this on spreadsheet. Okay, now obviously it was not a charge session, but I want just you all to spend the last 2 minutes on giving me feedback in the chat box in the question session. How did you find the session? Because that's the only motivation we get by listening to the feedback of how students found the session for all of you. And after that, we will sign off. So everybody, I will request everybody of you to participate on the feedback, please. Okay, really appreciate the positive comments from all of you. It's really motivating to know that the effort you put in was enjoyed